and welcome to this month's episode of Capital Markets View. Hello, Taron. How are you?
I'm good, Chris. How are you doing in second lockdown?
Second lockdown. Actually, I much prefer my normal entry to this, which is, "Hey, Taron, how are you?" Second lockdown is, we're virtually self-isolating anyway. And luckily, I have a lovely view of my garden, and I can see out the window the leaves changing. So I'm very lucky. There are a lot of people in a lot less fortunate situation than I am. How about you?
Yeah, as long as the nurseries stay open, I'm good. As long as I don't have to watch a toddler while I do my leverage finance work, I'm happy.
Oh, yeah, okay. Right, so let's go into our first slide, European new issue. And I mean, wow, this really, really highlights the way that high yield bonds are really, firing off. This is really an interesting slide.
Yeah, I mean, it just shows you how well high yield bonds have done, but also we have seen leverage loan issuance come back in September and October, and it has been busy. We have seen a bit of a reduction in October in terms of M&A. There was a lot in September, but I think there's a pretty good pipeline, and there's the ASDA deal that's going to come. I was talking to the journalist this morning, and the expectation is that's going to come before Christmas. So there's a bond component to that as well. So there's a lot of issuance that we probably will see. I think some of the corporate carve outs, we've got Philips appliances and the Unilever tea deal. I think it's unsure whether or not that they're going to come before Christmas or not. But the pipeline is busy for both loans and bonds. And Nina's going to have her LBO pipeline out probably by the time this comes out. So there is a lot of activity happening.
Yeah, it's interesting. I was getting quite mixed messages from private equity as we do our outreach to them about Q4, the tail end of this year. But actually, in the pipeline on the rating side, we've got a reasonable amount of deals coming up to rate. I think Q4 is turning out to be better than we expected. And Q1, I'm thoroughly expecting things to be good.
Yeah.
So let's go on to our next slide. Pricing, average term loan B rated, and it's come in a little bit. I personally perceive that because of demand outstripping supply. I mean, we've just said supply is good, but I think demand is even better. There's that real demand pull for assets.
Yeah, and we've talked about this the last couple of months, and I don't know if you remember, but I kept saying we are going to see pricing decline. Last month, spreads, when we compared Q3 to Q2, spreads had actually widened, but yield to maturities had come in because of the fact that we had seen the original issue discount shrinking. Now, we actually have seen spreads come in and yield to maturity. If you look at last quarter, the end of last quarter, as opposed to the 3 months ended October 31st, which you can see on the chart. And you're right, that is because there is still really strong demand. And actually, we've seen a lot of flexes down on loan transactions. So yeah, the monetary stimulus, like we've talked about many times, is keeping demand strong for bond and loan deals.
Hang on, you said the magic words flex down. Wow.
Yeah.
Okay.
Yeah,
I've missed that.
Yeah, we had 9 deals flex down and 3 up, and that was the rolling 3 months to the end of October.
Okay, that says it all, really, doesn't it?
Yeah.
Okay, let's go on to our next slide, debt to EBITDA. And, as long as you and I have been doing this, I think this ratio has been stable / slightly creeping up. But now it's very slightly creeping down, which I find quite interesting.
Well, yeah, and this is what we expected to happen after the crisis, right? In March, we expected to see all the deals coming out and being, sort of more sensible in terms of leverage. We didn't really see that. It's stable. It's 5.27 times for year to date, as opposed to 5.28 for 2019. And obviously some of our data is delayed because we don't always get all the documentation, right as the deals are pricing. So there's that element. But I think, if you look at buyouts, that leverage is actually still higher. It's the highest it's been since 2007. So the deals still are being structured aggressively. I think it's just some of the deals that are, maybe, aren't buyouts are bringing it down. But it does look a bit more sensible and a bit more what was expected earlier in the year.
Although, as you rightly said, we haven't seen what we would expect as behaviour during a crisis. So look at that dip you see in 2009. So, covenant light deals are still being churned out in the same way. Even though I've just said debt to EBITDA ratios are down a smidge, it's only a smidge.
Yeah.
So actually the market has continued with pretty much pre COVID structures. Pricing's a different matter, but pre COVID structures. And I think in the background, you've also got some really good equity check data.
Oh, yes. Investors can be assured by the fact that I looked, and for the last 12 months, we have an average of 52.2% equity check. And that's actually the highest it's been in the data that I looked at. So going back as far as 2009, which is when the last time it was, it was lower, but it was higher than any other year, 45.4%. So investors can rest assured from that. That can give them some comfort. And I think also last time we also talked about how spread per leverage, and I wrote a piece on this, has gone up. So investors are also, because pricing is higher than it was before the crisis, that they are getting compensated for the risk.
And you know what? That also rhymes with the kind of things you're seeing with new ratings. So, we did take a lot of actions on issuer credit ratings as the crisis broke earlier in the year, but recovery ratings have pretty much remained stable on new issues that we've rated, in the kind of upper 50s. And I guess one of the reasons why we must be, I mean, I'm not analytical, but I am assuming one of the reasons why we must be comfortable about our recovery rates is because those equity checks are going up. So God forbid something goes wrong, but there's an even bigger cushion underneath the debt. Cool. Okay. Next slide is secondary market weighted average bid of European loans. Hey, relatively stable pricing. Still under par. Functioning in a reasonably good way, I think.
Yeah, and I think the interesting thing about this is that we actually have just seen, we have seen for the year to date that this has actually gone, returns have actually gone positive for the first time since post crisis, and we'll be writing a quick take on that. That just for the first time we've actually seen the returns. So that's year to date post crisis go positive. So we have seen a return. We've been writing about that for some time, but it was a huge a huge sell off.
Yeah. And some people were fleet of foot and bought then, and some people didn't. I mean, and we've talked about it before, how in 2008-9 the market gapped down to 80 and then gapped down again to 60. So you had to be relatively brave to jump in when it was kind of like 80, and some people were, and they clearly were correct. So let's pop on to the next slide, European loans versus other asset classes. I love this slide, new slide. And hey, guess what? Shows Loan World is pretty damn good when it comes to monthly returns.
Yeah, and that's actually been for the past 2 months as well. So, this is a trend, and we've written about this as well. This is a trend we've seen for the last 2 months. Now, I'm not sure what it's going to show this coming month at the end of November, because obviously we've had the rally early this week, the vaccine rally. So equities, we may not be outperforming equities by the end of this month, just because of the fact that prices rallied so much. I think it was on Monday. Um, So we may see a bit of a change, but yeah, it is interesting to see how well loans have performed. European loans have performed.
And also, if you kind of look backwards before the COVID dip, it kind of shows that loans are a relatively stable investment. Predictable. You pretty much know what you're going to get,
Yeah.
as opposed to the equity one kind of bobbing up and down like a yo-yo. So yeah, hey, yay loans as an asset class. CLO volumes, October, good. I must admit, I thought that, well, there was a big rush before the American election, and I thought it was going to go quiet post 4th of November. Au contraire,
Mhm.
mandates are coming in, deals are being done. I think people are relatively comfortable that there is a degree of stability, and as a result of that, CLOs are carrying on. There's no gap in the market. I mean, I guess you guys are seeing that too.
Yeah, and Michael actually is publishing a topical, which will be out by the time this video is out. But yeah, I mean, he mentions in there just the fact that he's heard there are 36 warehouses out there. Of course, um,
Wow.
yeah,
Wow. 36? I'm noting that down.
yes,
Wow.
but
Okay.
but as Luke pointed out, 50 managers price deals last year. So that would mean that, on average, we're not seeing one from each manager. So that kind of did put it in context. But yeah, I mean, the story is that the excess spread, if you look at the difference between the weighted average cost of capital and the term loan B, which actually I think might be the next one of our slides, or
We can go on to the next slide. The next slide is AAA coupon.
oh yes, okay. Well, I mean, yeah, we can talk about pricing there. But yeah, the excess spread is 241 basis points, and anything over 200 is when the arbitrage is quote unquote working. Um, so so yeah, we are seeing favorable issuance environment for CLOs. So I don't know if you want to
Yeah.
go to the next slide and we'll talk about coupons.
Yeah, so if we now go on to the AAA coupon price, and looking at this graph, it's kind of evened out at about 110 to 115 to 20. That's where the AAAs are kind of settling. And given where loan pricing is, even though it's come in, I think the arbitrage is reasonable. Although you do have to take into account what's happened lower down the stack and where some of those prices have gone up a little bit. So again, so you talk about weighted average cost of capital, which is of course actually the key measure, although AAA is the largest part of what you're going to raise. But yeah, no, I mean, at the moment it seems to be reasonably good in CLO world. As you talked about, some people issuing, some people have issued a number of CLOs, and even the smaller managers seem to be, firing off their regular one a year. So yeah, and sizes have gone up again, and reinvestment periods are back to normal, and so CLO world really has done well.
Yeah, yeah,
Shall we go on to the last data slide, which is
yes,
default?
yes.
So this is the default rate in the Ellie, I think. Yes.
Yes, so this is the loan only default rate in the LE. We do track high yield defaults as well, but this is just the loan number. And Isabel just wrote a quick take where she talked about the rate your ratings data. Actually, she quoted it. And that we've gone above 200 defaults globally in 2020, which is the highest since 2009. So yes, defaults are high.
Yeah, and you know what? Sadly, defaults, lag, and covenant light will mean things will be drawn out a bit more, and sadly, the second lockdown, not just in the UK but across other parts of Europe, will tip certain businesses who are just about getting through into default. So we're predicting, by the middle of next year, I think it's 8.8 is the figure that we're predicting for the default rate, which is above the historic average of 3.3, 3.2, 3.3, but still below where past crises have spiked. And actually, this graph shows it perfectly, because
Mhm.
in the past, the upper reaches of a default cycle are around 15%, and where we're not predicting that as the kind of median level, but it's going to unfold sadly over the next 6 to 8 months. You're not going to see an 8.8% default rate by Christmas, but it will gradually build.
Yeah, and I do think that also we haven't. A lot of the default restructuring specialists have been saying that they haven't been as busy as they initially expected throughout all of this, which is kind of one of the key messages about everything hasn't been the way people have expected it to be. But the bond market has been absorbing some of the sort of more stressed issuers as well. They've been able to come to the market. So and it is a risk on market at the moment. So I think there is a worry that this sort of difficulties are being kicked down the road, and that we may see it later on because
Yeah,
there is so
and
much financing available now.
yes, yes. Although, interestingly, if you take a microcosm, a smaller section, if you look at what's happening in CLO world, the CLO managers on the whole have traded, weren't, as we went into the crisis, into what are perceived to be the more riskier sectors, and have actually, many of them have managed to manage the credits that were on the weaker end of the scale. So CLO managers have really proved that as active managers, they've on the whole, guided their portfolios in the right direction during this, and that their portfolios were pretty robust in the first place. Cool. Okay. Thank you. And we'll now go on to the last slide, which is a picture of the Japanese maple, the Acer in my garden, which is
Personal
turning.
image from you.
It's a beautiful red at the moment. No copyright on this photo. Feel free to use it far and wide. And of course, that means in about a month's time, I will be sweeping up lots of leaves. As we've both said before, we're very lucky. We have gardens to enjoy. That's an end of the November edition of Capital Markets View. I hope everybody is well and safe. And as ever, if you have any questions, feel free to contact me or Taron directly. Oh, actually, sorry, that's terribly bad English. Taron or I think it should be. So thank you very much, and stay safe.